So after all that optimism, the rate cut expectations for December now is just one rate cut of 25 basis points. This is after the FOMC meeting minutes, which came out this week, showed that the Fed was actually more concerned about inflation than they let on. And earlier this week, they also said that they don't expect to cut rates until they see several months of good data before voting to cut. The only problem is data keeps coming in hotter than expected, with today unemployment claims coming in much lower than the projected 220,000. And more importantly, the Fed's preferred inflation gauge, the PCE and core PCE, both came in higher than expected for the first time in a few months. Now, with that said, in the same week, the market also hit a new all-time high, although just by a little bit. But what does this mean for the market going forward, as we are now in the 19th month of this bull market, which is the median time period that bull markets last? So in this video, I will be giving you my take on the market. What do I see from here on out? How does the market typically perform when we are in a bull market of this magnitude, of this length of time? Also, Nvidia beat out earnings and reported record sales, surprise, surprise. But take a look at this chart here. Look at the difference between the S&P 500 chart on the right and Nvidia chart on the left. And you could see that really since 2022, Nvidia has been dictating the S&P's direction. Now, that's kind of an exaggeration here, but not really. When you look at the concentration of stocks here, you could see that we are coming off the highest level of large market cap concentrations here relative to 75% of the rest of the market. So what does this mean for the market? In this video, I will be giving you my take based on where we currently are. I'm going to take all the factors into consideration and give you the best possible analysis that I can. One other thing to note is that as of the time of this recording, the VIX actually hit the lowest point this year. So I'll also tell you what I'm buying, how I'm playing this market, and when I am planning to pull out of the market completely. Let's get right into it. So as I said, the Fed earlier this week had indicated that they were a little bit more worried about inflation than let on. At least that is what the Fed meeting minutes showed. And then Fed members themselves, when they came out and did their speeches, we're also saying that they are waiting for months of good data before cutting. And this is why we are now seeing the Fed funds futures swaps here. You could see that the market is only expecting a 25 basis point rate hike as the highest probability by December 2025. Remember, this year was the year we were supposed to get 6 rate hikes by the end of the year. And obviously that is not happening whatsoever. So with that said, I mean, honestly, this to me is nothing brand new. This is the narrative that's been going on for the last couple of months, but the data is definitely trending the wrong way. So could we get 0 cuts this year? Yes, I think that is a very high possibility. And the problem with that, obviously, is that the longer that the Fed keeps these rates up here, the higher the chances of something breaking. Now, if you watch me or this channel, you know that I'm not that optimistic about a soft landing. It is not something that we've ever done. It has never occurred. So why, if this channel is based off of data, would I bake that into my analysis? I really don't think that we're going to hit a soft landing. I think this is what we typically see before a recession, where the market continues to rally. There's liquidity in the system because we printed so much money, and taking liquidity out of that system and lowering inflation is such a tough battle that rates have to stay high until something breaks, and then the whole system, you know, falls, taking inflation down with it. That's really the only way that we've been able to fight high inflationary periods. So it's no surprise that if you look at the yield curves, you look at the data, that we are in a pre-recessionary environment. However, just like in the year 2000, just like in 2008, just like in 2020, the stock market typically hits all-time highs before a recession because the conditions that lead up to a recession are inflationary, right? And inflationary conditions are actually good for the stock market until the house of cards falls, right? So with that said, if we take a look at the market, where are we now? As I said, we are in the 19th month of this bull market here. And if we take a look at the data, you could see that the median length of a bull market was around 522 days. Now, since 1970, all bull markets except for 2 have gone on for longer than the median amount of time. And typically, when we've seen periods of high concentration like this, the effect that we tend to see is really that the rest of the stocks actually rise up to match the high concentration stocks versus the high concentration stocks falling to match the stocks that are still at lower levels. So with that said, as I've said in previous videos, right, when I've talked about recessions, I think there's sort of a confusion from some of the audience members where some of the less informed audience members will say stuff like, oh, you always talk about a recession, but you also talk about buying stocks, or you talk about a recession, but the market hasn't crashed yet. These two things are completely different. Yes, I still think a recession is coming. No, I never ever pretended to try to predict when that would happen. I can tell you with certainty that the time that I'm going to get out of the market completely is when the Fed does its first rate cut. Why? The market doesn't crash when the Fed does a rate cut. The Fed does a rate cut when things crumble and the market starts crashing. So go back and look at the first rate cut after the year 2000. It was in January 3rd of 2001. If you look at the first rate cut in 2007, it was September of 2007. Let's look at those on a chart. Right here, September 2007, if you got out here, you would have avoided the 50-60% drop in the S&P 500. And right here is January 2001, and you would have avoided a 50% drop in the S&P 500. And obviously, if you've been watching this channel, you know that if we're dropping 20, 30, 40, 50%, that's when I'm starting to buy. But we're very far away from that. So another thing, as I've said before, the S&P 500 has never not revisited a previous high. So in this case, we have these highs from January 2024 at around 477, and we have a high that hasn't been revisited from July 2023 at around 460. I believe that these are going to be visited whether now or later. Obviously, as I said before, NVIDIA earnings and mega cap earnings can completely derail any sort of correction that's coming, and the market can continue higher. But I do think that these levels will be revisited. And although we can get a stock market correction before the Fed cuts, I'm not leaning on a stock market crash until the Fed cuts. Now, admittedly, I'm not buying much here. I did most of my buying earlier, but there are a couple of things that I am very interested in. I've talked about the Bitcoin miners that have rallied nicely since I started talking about them, and I do continue to buy them on pullbacks because I do think that Bitcoin is on its way to crack all-time highs in the next 12 months. Obviously, I don't mind picking up Tesla here. This is one of the only mega cap stocks that actually has not rallied. And with this recent surge in bond yields due to strong economic data, I am looking at bonds once again. I believe that bonds can have a double-digit return in 2025 and beyond, because if bonds start inching toward that 5% yield and you buy bonds now and lock up that yield, well, when the Fed starts cutting, those bonds are going to go up in prices. So not only do you lock in that yield, but then you can also resell the bonds for much higher at a later date once those prices surge when the Fed finally cuts. So I do think that bonds are starting to get attractive here. I'm not yet going to be loading heavy into them. You can also leverage bond funds such as TLT, but in my opinion, it's not yet the time to go in heavy. I do think that yields can surge a bit further. I am going to be waiting for the next data drop of PCE, of CPI, etc., to see if data continues to come in strong, because if it does, I do think that bond yields will surge further, crashing bonds and bond funds, and I think that it will then be time to start pouring into there. I don't mind dollar cost averaging into TLT. Definitely would not dollar cost average into TMF, as that is a leveraged ETF that somehow there are some stock gurus on YouTube who are recommending people, buy into this and pile in on it, and they're already down pretty heavily because it's a leveraged ETF. So when the regular ETFs, regular bond ETFs tank, this is going to tank exponentially and will require a much greater rally in order to get your money back. That's why I don't buy or pile into TMF. I just use it for short-term movements. And there are a couple of beaten up stocks here that I'm looking at potentially buying, although not yet. Shopify is one of them. Alta is probably another one. But I'm definitely not buying indices here, especially as the S&P 500, as of the time of this recording, is printing this humongous engulfing candle at all-time highs, which is typically not a great sign and has been the start of pullbacks and corrections in the past. As you can see, this bearish engulfing in July 2023, which started that huge correction that ended in October. The one from April that led to that 5% pullback, and then we are seeing one now. So I would not be surprised to see a pullback / correction here in the short term. And that is partly why I am also buying the VIX here once again, as I've done before. Although the last time that I bought the VIX, which was, I don't know, I think a week or two ago from the time of this recording, those ended up expiring worthless. But to me, it doesn't matter because it's all a game of probability, and I don't have to be right every time as long as I'm right most times. I also just started my prop firm account copying journey. As you can see here, it's been going really well. Yesterday, I had a trade that I took $1,700 across 21 accounts. That's around 37K in total. I did a full tutorial here on how to copy your accounts. Make sure you check that out if you're interested. Every single day I go live with the team and I day trade live and I copy my trades over to these prop accounts, which is a game changer. It is really like a cheat code because you don't need a monster trade to have a monster day. Just one nice trade, one nice A+ trade can set you up, and if you are able to achieve consistency, can be life-changing monies. And as you can see here, a lot of our members already started copying their accounts and following along. So if you wanted to join us, if you wanted to trade live with me every day, make sure that you join below. If you wanted access to all of my trades in real time, make sure that you join below as well for all my trades and analysis, etc. Let me know in the comment section if you trade prop accounts, if you started copying trades. Also, let me know what buys or sells you are making at the market currently. Do you feel like the market is right now at an all-time high and you are offloading your stocks? Are you excited to buy some stuff? If you are buying things, let me know what it is that you are excited to buy. I'd love to hear from each and every one of you. So leave it in the comment section below. Give this a big fat thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.